Okay. Well, we're going to go ahead and get started for the folks in the room. Welcome. It's so nice to see you all. As Kim mentioned, we've this is our fifth week, I believe, and it's really nice to see faces in person. We only saw a couple over the last month, but it's really nice to have you all here, and especially at the IMPERS building. My name is Lisa. I'm with IMPERS, and Kim here is with Hoosier Start, and we want to welcome you to the final week of National Retirement Security Month. This is a month, October is the national month to recognize retirement security. And it's a big deal for us because it gives us an opportunity to remind you the importance of saving for retirement and remind you of the resources that you have available as you grow along your retirement journey. So today, for our last presentation this month on this topic, we're focusing on planning your exit strategy and the things that you'll want to consider as you think about leaving your covered position, moving into retirement. So this is a condensed version of information given the time that we have available, but know that there are many other resources available to you, which I will also share with you and Kim will towards the end of our presentation, so that you know what to do next as you give thought to retiring. So let's go ahead and get started. So again, I'm Lisa, that's Kim. I think you're probably familiar with us already. And this is our agenda today. So I'm going to briefly go over the plans that you have available to you here as employees of the state of Indiana. So we'll familiarize you with the two plans that are offered, as well as the retiree medical benefits account. And then Kim is going to talk about Hoosier Start, your 457 plan, once I conclude. So the important thing to know about your plan is that you'll want to be familiar with how it works and then what it is that you can do with it as you enter this final phase of your covered employment. So all state of Indiana employees are enrolled in one of these plans. For those of you that have been here for a long time, prior to 2013, you're enrolled in the hybrid retirement plan if you've worked here continuously through that time. If you came on after 2013, you were given a choice of plans, either the hybrid or the My Choice plan. If you were rehired, you were also given a choice of plans, either hybrid or My Choice. Okay? The majority of state employees are enrolled in the hybrid plan. That is the default plan and the one that's been available for state employees since we were started. Okay? And then the My Choice plan, as I mentioned, that one is newer since 2013, and employees since 2013 have a choice of plans to participate in. But we're going to go over both of them so that we make sure everyone understands whichever plan they are enrolled in. So the My Choice plan I'm going to go over first because it's actually the simpler plan to explain. So this My Choice plan, again, it's available for state employees who were brought on after 2013, and for any rehires, anyone that may have returned to the state of Indiana is given a choice whether you want to continue in the hybrid plan or choose the My Choice plan. The My Choice plan is different than the hybrid plan because it is a defined contribution only. So it does not have a pension. Okay, it's a defined contribution only, meaning that contributions that the state makes to it are defined, and they require that you work a certain number of years to be fully vested in all of them as well. So there are fixed contributions that go into it that are 3% of salary that the state funds for you. There's also a variable rate contribution that is also contributed by the state on your behalf. That variable rate can change every year. The current rate is 4.2% of salary, and that's in effect until the end of June of 2025. So if you're participating in the My Choice plan, these are the contributions that are going into the account for you. With the variable rate contributions, they require that you work a certain number of years before you're the full owner of those contributions. But with the fixed contributions, you're the full owner of those. So every pay period, you can look and you can see those contributions that have been made into the account for you. And those entirely belong to you. The variable rate allows for you to vest into those contributions 20% each year, so that at the end of 5 years, you're fully vested in the My Choice retirement plan. So that means you're the owner of all those contributions and any subsequent contributions that are made to the plan as you continue to work in your covered position. So that's the way that the My Choice plan works. You're fully vested after 5 years of service in that plan. At retirement, you can choose what you'd like to do with all of those contributions and all of the investment experience that those contributions have had. So at the time that you decide to retire, you've got a balance of money there, and you can choose how you would like it distributed to you in your retirement years. So you've got choices. You can choose to take your balance and purchase a lifetime annuity that would pay you monthly for the rest of your lifetime based upon that balance. If you were to choose to do that through NPERS, MetLife is our annuity provider. So MetLife would make that payment to you monthly for as long as you continue to live. You've got other choices. You can choose to withdraw money from your balance as a lump sum. You can also withdraw it in partial amounts as you need it. There's also a systematic withdrawal plan where you withdraw an amount that you would like to receive over a period of time, and you can always make changes to that dollar amount as well. You can also roll over your balance to another qualified plan, and Kim will talk some more about that later. So with the My Choice plan, you've got a balance at retirement, and that balance you determine how you would like distributed to you. So the My Choice plan is pretty straightforward. Again, that's for employees who have chosen to participate in this plan, and those employees are ones who have been hired after 2013 or rehired since 2013. But next, let's talk about the hybrid plan. And this is one that many of you may be enrolled in if you've been with the state for a very long time. And you probably heard plenty of things about it. So the hybrid plan, we call it hybrid because it's got two parts. It's got a defined contribution, and it's also got a defined benefit, which is also known as your pension. So you can see here that I've got the acronyms here because you hear us refer to the defined contribution also as the DC. And you hear us refer to the defined benefit or pension as the DB. So be familiar with those because you may actually see it in some of our information that we hand out to you as well as in our handbooks. But the two pieces you have if you're participating in the hybrid plan, and at retirement, you choose what to do with each piece. In order to qualify for retirement from the hybrid plan, these are the ways in which you do that. Now, oftentimes I will talk to people, whether we're at the State House Market or at community events or at the health fairs and things with the state, and I'll often hear people say, well, I'm not eligible because I don't have my 85 points. You don't need 85 points. There are other ways to retire as well from the hybrid plan, and these are those ways. So if you've got 10 years of service, that gets you vested in the plan. As long as you've got 10 years, you are eligible for retirement at the age of 65. If you are age 60 and have 15 years of service, you're also eligible for normal retirement benefits, age 60 with 15 years, okay? Then there's also that rule of 85. Which requires that you be at least age 55 and your age plus your years of service total 85 or greater. That also gets you eligible for full retirement benefits from the hybrid plan. Okay. And then I've got an example there on what that could look like. If you're 58 with 29 years, obviously you've got more than 85. If you're 55 with 30, that gives you 85. Okay. But you have to be at least age 55 in order to qualify for the rule of 85. If not, age 60 with 15 or age 65 with 10, okay? There are other ways to retire as well from the hybrid plan. There's an early retirement that's available if you qualify with age and service requirements. So if you are in your 50s, so between the ages of 50 and 59, and you have at least 15 years of service, you are eligible to start your retirement early. So it could be that you need to leave your covered position in order to handle business elsewhere or take care of someone, maybe move out of the workforce. you have the ability to start your benefit as an early retirement, but know that it is a reduced benefit that stays reduced for as long as you continue to receive it. So I've got a couple of examples here on what that reduction would look like. If I'm 50 and I've got 15 years of service and I need to stop working, terminate from my covered position to take care of a relative, and I decide that I want to start my benefits early, I'm going to receive 44% of the benefit I would have had I waited until my 60th birthday. If I'm 59 and I choose to retire early with 15 years, I'll receive 89% of the benefit I would have had I waited till my 60th birthday. So early retirement is an option for you if you decide to do it. Just know that it is a reduced benefit and it remains reduced, so it's not going to go up later on. In addition to this, say that you are in your 50s and you've got 15 years, but you leave your covered employment and you go elsewhere. Say you go to work for Target. So either you want to work at Target. You don't have to start your benefit. You can wait until you're age eligible for a full benefit. Okay? So don't feel as though, hey, I'm stopping working and I need to start my benefit now. You do not. Just know that there's a benefit waiting here for you when you are age eligible for a full benefit. Okay, so it's important to always keep your information current with us. We're going to continue to send you statements and information, so be sure that your beneficiaries as well as your address are consistently updated with us so that we can keep in touch with you. There are also disability benefits available from the hybrid plan. So if you become sick or injured and you've been deemed disabled by the Social Security Administration, as long as you have at least 5 years of service, this benefit will pay disability income to you for as long as your disability exists. So if you find yourself in that situation, get in touch with us so that we can work with you to help you qualify for those benefits and get it started for you. There's also survivor benefits before retirement, because we do have members that pass away before they get the opportunity to retire. If they do that, then they are vested, their benefits are then paid to their surviving spouse or dependent children. So be aware that that does unfortunately happen, but benefits will be paid to those survivors. Okay. Other ways to retire. There's so many. That's what makes this plan so unique. There is a Millie Morgan retirement, and this is the retirement that's available for our members who are at least age 65 and have 20 or more years of service. They can start their retirement benefits and continue to work in their covered positions. Pretty unique. Yep. And we have a lot of members taking advantage of this. So it allows for you to continue working and receive your salary, but also receive your retirement benefit at the same time. So a unique way to retire. There's also retirement for elected officials who are at least age 55 with 20 or more years of service, can start their benefits and continue in their elected positions. So a couple of unique ways to retire, but continue to work at the same time. So there's a lot here. So at the time that one retires, you have choices. As I mentioned before, there is the defined benefit, and then there's the defined contribution if you participate in the hybrid plan. Now, the defined benefit is paid to you for as long as you continue to live once you get it started. The amount that you receive from the defined benefit is based on your age, your years of service, the average of your 5 highest salaries, as well as the income option that you choose when you retire. All those things are going to influence the amount that you receive from the defined benefit, but once you start to receive it, it's paid to you for as long as you continue to live. At retirement, you get to choose what happens to it after you die. So we're going to pay it to you monthly for your lifetime, but the choice you make when you complete your application is what happens to it after you pass away. So you can choose an option that just pays you for your lifetime and it stops at your death. Or you can choose an option that pays a beneficiary for a period of time after you pass away. Or you can choose an option that includes what's called a survivor. That's one other person that would receive your benefit after you pass away, and they would receive it for the rest of their lifetime. So you've got choices available to you. A nice way to see what all of those choices would pay you, because the dollar amounts are different depending upon the option, is to get a benefit estimate from NPERS. And you can do that by logging in to your account at mynpersretirement.org. And you can do a benefit estimate calculation to see what each of those options would pay you at different retirement dates and including different beneficiaries or survivors. Okay. All right. The defined contribution, the other part of your plan. So at the time that you retire, you can just start to receive your benefit, your pension benefit. And with your defined contribution, you could leave it invested if you wanted to until you may need it later on. Or at that time, you can choose to set it up for some sort of payment stream. And you've got choices with that as well. So with this, you can also purchase an annuity, just like with the My Choice plan that we discussed. You can choose to take your balance or a portion of it, and you can purchase a lifetime annuity that would pay you like a pension. Again, if you do that with us, MetLife is our annuity provider, so they would make that benefit payment to you. There's a lump sum withdrawal, so you can withdraw your defined contribution balance if you want to, or portions of it, so you do pay taxes on your withdrawals. As well, you could do a rollover, move that money to another qualified retirement plan like Hoosier Start or elsewhere, something at your bank or with a brokerage. And then you also have systematic withdrawal available to you, where an amount from your balance is paid out to you over a period of time. And you can always make adjustments to that payment if you like. So you've got a lot of choices and a lot of flexibility. With your defined contribution, you're not limited to just one option. You can say, you know what, I've got a $25,000 balance. I want to withdraw $5,000 to go on a trip once I retire. Another part I want to take and put a new roof on my house. I want to leave the rest for later on. Okay, so you're not limited to just one option. You can take advantage of all of them with your balance. All right, important to know, this is something that I mentioned to you before. So if you are leaving covered employment and you're vested but not eligible for benefits based on your age, know that we want you to come back when you are age eligible and apply for your benefits. Because putting it off after you're age eligible, if you're no longer working, it's not going to enhance your benefit like Social Security. Okay, so if you're eligible, you're no longer in your covered position, then you would want to go ahead and start your benefit. Stay in touch with us. Let us know where you're living. Keep your beneficiaries updated so that we know where to contact you and we can continue to provide you with information about your account, even if you're not in a covered position. All right, so when to apply. So you could apply for retirement. I'm going to make sure I'm not going to trip over this. You can apply for your benefits once you are within 6 months of age and service credit necessary for your retirement. Note that it takes us about 90 days to process your application. So we suggest that you apply about 90 days in advance of your retirement date. It's okay if you apply in a shorter period of time than that. It wouldn't be unusual. Every now and then we do get someone coming into our office on a Friday afternoon and saying, I'm not coming back on Monday. How do I apply? Okay, that's fine. Just know that it will take us about 90 days to process your application, but we will pay you retroactively to your retirement date. Okay. There are many ways to apply for your benefits as well. How many of you have logged into your account, those in the room? Okay, quite a few of you. Excellent. Wonderful. That's a great crowd. Good. So if you log into your account at mynpersretirement.org and you navigate to the applications and calculators section, it's there that you'll find the benefit estimate calculator as well as the retirement application. And the application itself is only about 4 to 5 steps. And you can start it and say you're not quite sure about some things, or you need to gather some additional information. It will save there and it will wait for you to come back, and then you can log back in and add on. And then once you're ready, submit your application so that we can process it. So you can log in yourself and do that. If you need help, even as you're walking through it, you can contact our member advocates at 844-GO-INPERS, and we can guide you through it over the phone and answer any questions that you may have. If you're more of a in-person kind of person, we'd be happy to meet with you to walk through your retirement application. So we have a whole counseling staff that's located around the state. So if you're not in Indianapolis, if you're in another part of the state, then one of our counselors can meet with you face-to-face and help you fill out the application. We meet with members in libraries and around local areas in order to assist you. Also, we do virtual appointments. So if it's easier for you to meet on Teams to do your application with a counselor, we'll be happy to do that with you as well. So we meet you wherever you're at. Just be sure to let us know how it is that you'd like to interact with us and what kind of support you need, and we'll do our best to assist you. All right, so when you do apply, you do need to have some things with you for the retirement application. So first and foremost, you do need a personal email address. So not your work agency address. We want you to have you will need a personal address. So your Gmail, your Yahoo, your AOL, personal email address for your retirement application. Next, you'll need a retirement date, which is always the first of the month following your last day worked. Okay, so if you're going to work through Thanksgiving, which I think is like the 27th this year, so then, and you decide that you're going to retire after that, then the 1st of December would be your retirement date. So it's always the first of the month on your last day worked. Okay. Your retirement plan option, you want to be familiar with what option you want to go with, because you will need to indicate that on your application, as well as that of your defined contribution account. You want to tell us what it is that you'd like to do. With your defined contribution account, as I mentioned before, it could be that you just decide that you want to start income on your pension and you just want to leave your defined contribution invested for the time being, then you may certainly do that. You can come back later and decide what you'd like to do. Your survivor and beneficiary information. So if you're going to be choosing an option that involves a beneficiary or beneficiaries or a survivor, you will need to have their information. So their name, address, social security number, and birthday for the application so that we know who to contact in case something happens to you. Tax information, you'll fill out tax forms on the application for both federal, state, and county. So there's guidance on the application itself, but certainly call us if you need some assistance filling it out. And then we're going to need your bank account number and routing number so that we know exactly where to send your payment to electronically when it's ready. Okay. Log into your account if you haven't already, but I will say that I think the majority of this room is logged into their account already. So that's really impressive. Nice work. So that's where you log in. This is an example of a benefit estimate if you have not seen one in the past. A little blurry on this screen, but when you do log in and navigate to applications and calculators, and you put in a potential retirement date, it will produce for you a list of all the options that you have available and the amount of payment that you will look to receive from each one. You can also put in a survivor's information so that we can see what a potential survivor could receive from your benefit should you pass away. So this is a really valuable tool as you do your retirement planning. So be sure to take advantage of a benefit estimate. If you need help getting one, if you find that it's challenging to get one from the website, contact us so that we can help you get one or send one to you, okay? Because it's probably the most important tool as you go through this journey. This is a snapshot of the application. As I mentioned before, it's about 4 or 5 steps that you go through in order to submit your information. So the application is entirely electronic. It is not on paper. So that's why it allows for you to log in and do some of it and then save it for later. if you need to come back. So what happens after you submit your application? Allow some time for processing. As I mentioned before, it takes us about 90 days to process. And then after that, you'll be contacted if we need any additional information from you. And that's why it's important to have your personal email address, because we'll certainly reach out to you there. But if you submit your application 90 days in advance, you can expect to receive your first benefit the month after you retire. And after your first benefit, all payments for PERF members are made on the 15th of the month, or before that, if the 15th falls on a weekend, it would be made on the Friday before. If you need help, don't hesitate to let us know. So this is a condensed version, very condensed version of our pre-retirement workshop, which actually we offer every Wednesday. There's one today. So if you wanted to log into that as well, it's a longer presentation. It's done virtually. We also do pre-retirement workshops in the communities around the state. So if you would like to see when the next one is in your area, simply go to our website and look at our workshops and counseling schedule and register for one. It's there that we do a deep dive into each individual option and all the things that you want to think about in great detail as you plan to apply for retirement. All right, there's another piece. Oh, and before I wrap that up, we have these financial guides over here on the table. And for those of you online, it's actually on our website under publications. So there is a great retirement checklist in the back here. That's also a valuable tool as you do your planning. So I encourage you to have a look at that as well. All right, one more thing from me before I pass it over to Kim is I also want to tell you, as state employees, you participate in the retiree medical benefits account. This is not something that you had to enroll in. You were automatically enrolled into it if you're eligible for benefits with the state of Indiana. So the retiree medical benefits account, we also call it RMBA for short. So you may see this acronym, but it's an account that's been established for state employees, and contributions are made to it annually so that when you retire, those or your balance that you have, you can use to pay for insurance premiums in retirement. Okay. So it's available for retirees or for state employees who retire who are eligible for normal retirement benefits. So not early retirement, but normal full retirement benefit eligible members, okay, as well as disability retirement. So members of both the hybrid plan as well as the My Choice plan participate in the retiree medical benefits account. So the state funds contributions to it annually at the end of June every year based upon your age. So this is an example of what those contributions are. If you are under the age of 30, you receive $500 in the way of a contribution annually. Between the ages of 30 and 40, $800. Between the ages of 40 and 50, $1,100. And if you're at least age 50, $1,400. Okay. So those contributions, again, annual contributions that are made. In order to be eligible for the contribution, you have to be employed as of December 1st of the prior year, December 31st of the prior year. Okay. So the accounts, again, are used to pay for premiums for individual or group health insurance coverage or long-term care insurance for retired participants, as well as their spouse or covered dependents. If the member passes away and still has a balance that has not been used, then that passes on to the surviving spouse or covered dependent to use for their insurance premiums. All right, for eligible members who retire from state employment, again, with full retirement benefits is what allows you to be eligible to use this balance. There is no application that you fill out to be enrolled in this. You're automatically enrolled in it. Once you retire and receive your first retirement benefits from NPERS, you will receive information in the mail from the retiree medical or about the retiree medical benefits account. So you don't even have to apply to get it started. We handle that for you. Once we process your retirement, Then you'll receive information about the retiree medical benefits account from our local record keeper, who is Key Benefits. They will send you a welcome kit and all the information that you need in order to file for reimbursements and get paid from that balance. All right, I know that that's a lot of information. I'm going to pass it over to Kim, and then we're available for questions afterwards. Okay? Here you go. Watch your step.
Thank you so much. Again, it's a real pleasure to see everybody in person. For those of you that don't know me, I'm Kim Rumpel. And I have to tell you, as usual, Lisa has carried the lion's share of our time today as appropriate because of all of the decisions and all of the information related to your NPERS benefits. I have the easiest part today. And that is, if you've ever heard me talk about this particular subject and planning your exit strategy, Hoosier Start's very easy because you don't have to do anything. It's not a decision that you have to make. There are no applications that you have to complete. Only if you are moving money into the plan or moving money out of the plan. When you separate service, do you have to actually do anything? But I do want to go through a bit of information, very similar to the DC or defined contribution account that Lisa spoke about earlier. Your Hoosier Start account is a balance that you own. If you choose to make that part of your pension, that is an option. You can combine that with your DC account. You can also choose to leave the Hoosier Start account intact without making any decisions, meaning you can continue to make investment choices. You can continue to receive all of the benefits that you had as an active employee that you would as a retiree. In other words, retiring or separating from the state does not increase your fees or change any of the benefits that you receive through Hoosier Start. So you can choose to keep your Hoosier Start intact completely. You may also choose to take periodic distributions, which means if you decide that you do want to take money out of the account and you want to set up a recurring monthly, quarterly, semi-annual, or annual withdrawal, you are welcome to do that. You may also choose to take it as a lump sum. Again, as Lisa mentioned, with the defined contribution account, any distributions that you take will be taxable. They are taxed at a flat 20% before we send that to you. But I want to be very clear that that 20% is required by the IRS. It does not mean that that is what you owe. So very much like your W-2 or your withholding form that you submit to your HR department when you receive your biweekly paycheck, you elect how much you have withheld, and then you settle up in the spring with the IRS. Sometimes you get a refund, sometimes you owe a little bit. With your withdrawals from Hoosier Start, the IRS requires a flat 20% tax withholding, okay? Then at the end of the year, when you file your taxes, we will send you a tax form and you will settle up with the IRS at that time. You may not owe that amount and you may get a refund depending on your own individual filing status or household filing status, or you may owe a bit. You can always choose to withhold more than 20% in federal taxes. You may also choose to withhold state and county taxes when you make a withdrawal. Indiana is not a mandatory withholding state, so that's an election that you will make if you choose. But we will always withhold the first 20% and report that to the IRS. Okay, that's regarding any distributions, whether you're doing that monthly or on a regular basis, or if you're doing it intermittently. You may also choose to roll your Hoosier Start account into an IRA at a bank or a brokerage firm if you choose. That is entirely up to you. There is never a time frame that you have to do that. You can leave your Hoosier Start account with us indefinitely. And if you decide at some point down the road to do otherwise, you are welcome to do that. The only comment I will make on that particular note, I get at least one phone call a year and somebody has rolled their balance to an IRA at a bank or a brokerage firm. And for a number of reasons, they may be unsatisfied with what they have entered into with that bank or brokerage firm, and they want to move the money back to Hoosier Start. If you have liquidated your Hoosier Start account to zero, there is no way to get back into Hoosier Start without coming back to employment. When you're leaving, that's generally not the intention. So I would just be mindful that if you do decide to roll the balance to another account, there's no way to roll it back in if you're unsatisfied at some point down the road, okay? You may do any combination of the above. So if you, for example, decide that you want to supplement your pension and possibly your Social Security income with a monthly withdrawal from Hoosier Start, and you set that at for an example, $500 a month. The analogy I use is kind of like having your hand on the kitchen faucet handle. You can choose how much you take out of your account. You can stop, start, let it drip. You can change the amount. That is entirely up to you. If you are receiving a periodic withdrawal and there's an expense that comes up, you are still eligible to take an additional lump sum. So how you spend this money is entirely up to you. Okay. Couple of things I want to touch on as you are entering the final phases, presumably of your retirement. For 2024, the contribution limits are $23,000 under 50, $30,500 if you are over 50. That can be on a before tax basis and or a Roth basis. So you may contribute a combination before tax and Roth, but cannot exceed $23,000 or $30,500. The state will stop you when you get to the maximum. The last thing that I want to bring to your attention on this particular slide is special catch-up. This has become particularly relevant in the last year or so with Millie Morgan. Lisa was kind enough to go through Millie Morgan and explain that if you are 65 years old with at least 20 years of service, you're eligible to turn on your pension and continue to work for your salary. What that may mean for some of you is additional tax liability. It may also mean an additional opportunity to save more in your retirement for the remaining years that you're working. So if you find yourself in that situation, there is a unique clause in the 457 called special catch-up, which would potentially allow you to contribute up to $46,000 a year for 3 calendar years. So if you find yourself in that situation, see me separately. It's a very unique clause. There are some things that we need to walk through to make sure that A, we understand all of it, and B, that you are eligible for it. So it's a case-by-case basis, but I'm happy to discuss that with you in detail. Again, you may change your contributions at any time throughout the year. That is one of the biggest misconceptions in the field, is that you are relegated to open enrollment to make changes. This is not like any of your other benefits where you make an election at open enrollment and are stuck with it for the remainder of that year. The changes that you make to Hoosier Start take a pay period or two, but you could change them anytime throughout the year. Okay. There is a fee for Hoosier Start, $54 a year, that is charged out of the Hoosier Start account at $13.50 per quarter. That is still true if you are separating service and keeping your Hoosier Start account. You get the same benefit of the reduced fees as a retiree that you do as an active employee. Lisa mentioned to you rollover and the option to rollover accounts into Hoosier Start. That could include your defined contribution account. If you're a separating service and would like to consolidate the accounts, you are welcome to do that. You can either make that election at application when you speak with NPERS to file, or you may make that decision at some future date. And there is no time frame on our end again. And to my knowledge, there's no time frame on NPERS when that has to be decided. That could also include prior 401ks, other 403bs, 457s, or traditional IRAs that you might have if you're looking to consolidate so that you have fewer accounts to worry about in retirement. You're welcome to use Hoosier Start as home base and can continue to do that long term. So what's next? We have QR codes for you to access both your NPERS account and your Hoosier Start account. I would also encourage anyone who is in the final stages to use all of the resources that the state provides for you, the services provided through NPERS to help with your retirement application and understanding your benefits, the time to meet with me or one of my colleagues regarding all of the details, including how your pension and your Social Security work with Hoosier Start, how you might consider using Hoosier Start, or any of number of things up to and through retirement. In fact, we just recently sent a retiree letter to make sure that our retirees know that they have access to the same services that they did while they were employed. So I encourage you to take full advantage of all of the resources that are available. There's a lot of information and a lot of decisions that have to be made, and we want to work together to make sure that you make all of those in a timely fashion that are appropriate for you. The other thing that I would bring to your attention, we don't have a slide for this. If you have not attended the state personnel all-day pre-retirement seminar, I encourage all of my clients to do that. It's typically twice a year.
They're going to do it 3 times.
Yep. In 2025, they're adding a third date because it's an extraordinarily popular opportunity for you to attend a session all day you will be exhausted. I am exhausted when I stay all day. But it is a one-stop shop all day to hear Social Security, the enhanced version of NPERS and all of the things, I speak, long-term care, legal matters, etc. So if you have not attended that session, I encourage all of my pre-retirees to attend that all-day session. Spouses are welcome. And depending on your department, it's typically covered at least once by the state, so you don't have to use personal time to do that. So again, all of the resources at your disposal, I encourage you to take full advantage of those. This is the last Wednesday that we will present for National Retirement Security Month, but we continue to work closely to make sure that you all are retirement ready. So if you'd like to schedule time, you have my email address as well as my phone number. The best way to reach me is via email. If you would like to meet one-on-one, depending on where you're located, if I'm in person, I'm happy to do that, or we can always meet virtually via Teams. We've been very successful meeting virtually to go through all the information and help add some clarity. So thank you very much for your time. It's always a pleasure to partner with NPERS to help provide this information. And if you'd like to reach out to either of us, feel free to do so at any time. Okay?
I have a question.
Absolutely.
The 30,000 maximum, or whatever that number was, for the Hoosier Start, is that the consolidated amount that you're putting in for Hoosier Start? Let's say you have Hoosier Start and defined contribution. That's your cap for both, or that's only for Hoosier Start, and you have some other cap over here on the defined contribution?
So the 30,500 contribution limit is for Hoosier Start only. That is independent of an IRA contribution that you may be eligible for, and it's independent of any contribution that you may be making to your NPERS defined contribution account.
Okay, thank you.
Absolutely. Anything else in the room?
Oh, while you're
Yes, ma'am.
standing there, do you mind mentioning about the 3 different places to keep your addresses
Absolutely.
updated?
Yes.
Yeah, that's what I
Yes. Thank
forgot.
you very much. Lisa has reminded me, we have collectively decided we're going to change the way that we present this information. Lisa shared with you to please make sure that you keep your address and beneficiaries updated on NPERS. We have changed this to tell you, and please tell every single person that you meet between here and the time you get back to the office, there are 3 places in the state that you should have beneficiaries listed. PeopleSoft for life insurance and any benefits that you receive, NPERS, and Hoosier Start. Okay, this is one of the biggest misconceptions in the field. If I ask someone, do you have beneficiaries on your account? And they say, I have them on PeopleSoft. We do not know that at Hoosier Start. NPERS does not know that either. So there are 3 places that you should have beneficiaries: PeopleSoft, NPERS, and Hoosier Start. Although Lisa and I work hand in hand and our agencies work hand in hand to make sure that you are retirement ready, we do not talk to each other electronically. So if you list them on NPERS, we don't know that, and vice versa. So please make sure that they are listed on all 3 places appropriately and that they are updated if there is a change in your personal situation at all 3 places. Okay, thank you very much. Yes, sir.
For the beneficiaries, if something happens to me, my wife gets my retirement and everything else, will she continue to get it if she remarries?
Yes.
But, are we talking about the pension specifically?
Yes.
Okay, yes,
Yeah.
yeah, that's a
I'll
Lisa
continue to
question
receive
for
it.
sure.
Yes.
Yep. Anything else? Great or good? Yes, sir.
Did you guys start a brokerage? I remember seeing an email, brokerage accounts through Hoosier Start also.
Yes, sir. So in January of this year, the plan overall elected to add what they call a self-directed brokerage account. It is held on the Schwab platform. I would be happy to discuss that in more detail, or I'm more than happy to send you some additional information. It's a very unique plan addition, and typically the vast majority of people may or may not take advantage of it, maybe not, but it is a very unique provision that allows you to use independent investments through a brokerage platform for part of your 457 account.
One other question for Lisa.
Mhm.
Did you cover like the 13 check versus the 1% cost of living adjustment that?
Sure. So it still remains to be seen whether it will be approved for the future. However, based upon if you retire, and Natalie is here as well, so she can refresh me of the date. July 1st, 13th check, and cost of living increase, the date is June 30th, I believe. Sorry, I'm gonna get this.
When it switches over.
Yeah, you can go ahead. I'll get this for you. If there's another question.
Ashley didn't go that.
All right, well, Lisa and I'll stay around for a few moments. If you have questions, we'd be more than happy to discuss those. For those of you online, they're still with us. If you want to shoot me an email with any questions that you have or to put time on my calendar, I'd be more than happy to visit that way as well.
I do have a question.
Yes, ma'am.
Submitted online with regard to Hoosier Start.
Please.
They said they are retired from turf in 2021, but they're now in perf, will stay in perf until June 30th, 2025. They will retire again then. Can I roll my perf into the Hoosier Start?
Yes, there will be a defined contribution balance, should be a defined contribution balance in perf or in PERS that would be eligible to roll into Hoosier Start. Mhm. Yep, absolutely. Wonderful. Well, thank you very much. It's been a pleasure to see all of you in person and those of you online as well. So
I'll
thank
hang
you
out
for
here
your
for a few
time.
more minutes.